let me start with something rather uncomfortable. The central bank you think exists no longer exists. The one we, you, me learned about in all of the textbooks, price stability, full employment, neutral rates, inflation targets, the neutral rate, that institution is well and truly gone.
But the food isn't steak,
now,
it's liquidity.
It wasn't voted out, and it certainly wasn't and hasn't been replaced. It didn't announce its resignation. It simply just evolved. Which is difficult for us to come to terms with. Because today, whether anyone wants to admit it or not, the central bank has one primary mandate.
Just let the stimulus come through.
Just one. An important one, but a primary one. It's to protect the balance sheet. It's evolved. And the balance sheet is not yours. The balance sheet is not mine. It's the system's balance sheet. That is the number one mission du jour of the central bank, whether it's in Bank of Japan, ECB, BOE, or the Fed. Everything else you see is pure theatre. So what was the old mandate? If this new mandate is something different, it must, by logic and by virtue of it, mean there was an old mandate. Well, once upon a time, and I mean decades ago, central banks pretended to optimize. That was their job. Optimization and the smooth amelioration of any choke points. Price stability and full employment. What were the things that you heard central bankers of yesteryears mainly talking about? I remember it. Well, I'm not as old as many other people, but I do remember them talking of CPI targets, inflation, full employment, output gaps, productivity, and other things of that ilk. No longer do they talk of those things though. They used to talk of Taylor rules and the Phillips curves and things like that, but that's completely evaporated from their sense and sensibilities and their mandate. They used to be highly data dependent. They used to be monitoring the data. They used to be adjusting and responding to the productivity and to the transforming and ever-changing variable data. But that framework made sense in a different world. That framework made sense in a world where debt levels were manageable, where the debt burden and the interest serving cost wasn't gargantuan. Banks could fail without entirely collapsing the system. The pipeline towards transmission and the people at the end of the spigots were actually disciplined. Bond markets respected and adhered to the wishes and the prevarications of governments, and rates could actually move without breaking something. That's not the world that we live in now. And that's not the central bank you probably recognize today, simply because that world no longer exists. And it hasn't existed, if you're completely honest and candid with yourself, for a very long time. No, it's not because policymakers are incompetent. It's because something diametric has happened, something antithetical. The arithmetic has changed. And arithmetic is highly, highly rigid in its mathematical principles of unchangeability. The arithmetic that ended the monetary policy is where we should be looking in terms of where the bodies lay, right? Here is the part that nobody on financial television, at least the pundits that I watch and you probably watch, actually tend to say out loud. The system is now far too levered to tolerate any type of volatility. And that's why you have entire niches of vol suppression funds, volatility suppression from central banks, volatility suppressions from primary dealers. Not high rates, no, that's not the regime, it's volatility. Because rates are just numbers. Volatility is actual stress, and it's very different. Volatility and the volatility of volatility is what really causes the cascading effects of liquidations, capitulations, acquiescence, and systemic collapse. And stress reveals where the leverage truly is. That's where volatility becomes incredibly important. Every modern financial crisis has the exact same origin. It's not inflation. It's not the boogeyman of inflation, although inflation is important. It's not debasement. Debasement is incredibly important, and the hurdle rate to ensure that we don't become victims of debasement is entirely important. It's not growth. It's not inflation. It's not unemployment, even though the primary mandates of all of these central banks is apparently price stability and full employment. It's rather a duration mismatch and leverage exposure hiding inside central bank and private institutional balance sheets. What do I mean by that? The primary stressor is banks, it's pensions, it's unfunded liabilities and obligations, it's insurers. These are the key stressors, not to mention the shadow lenders, the shadow entities that exist in a form of miasmic Q. It's the sovereigns. These are the true stressors, the arbiters and the controllers of incredible amounts of wealth and assets. When yields move too fast, assets collapse before inflation can even be and is even addressed. Now that is the constraint if we're talking in terms of economics. That is the simple 101 macroeconomics constraint. So what central banks actually watch is something different than what we are told on the television. And it's something different to what we learn in econ. You think they're watching CPI prints, and that makes complete sense. Inflation, when unabated and allowed to run away like a runaway train, is incredibly deleterious to people's wealth. But the central banks are not watching CPI. They watch something entirely different, which might actually blow your mind. The things the central banks actually end up watching is the funding markets. What are the funding markets? We all know what those means. The credit markets, the capital markets, the sovereign debt markets. They watch the repo conditions, repurchase conditions, how easily banks can get capital, how easily reserves are swimming through the system, and how high the levels of trustworthiness are between entities who transact trillions of dollars and other denominations of currencies each day. Central banks watch things like bank equity, bank reserves, dealer balance sheet capacity, all of these things that never seem to be mentioned in an FOMC briefing or in an ECB, BOJ, BOE. Not that I can speak Japanese, but I'd imagine it's not there either. I've read the notes and they're highly prosaic, esoteric, and quite dry. They're watching duration convexity. They're watching collateral velocity. They're watching the stress in funding markets, the unalloyed conditions in the repo markets, bank equity, dealer balance sheet capacity, duration convexity. They watch whether the plumbing still clears and whether the liquidity can make its way from the main source through the antiquated and, quite frankly, archaic plumbing system. Because the moment it doesn't, that's when the system entirely stops functioning. And when that happens, inflation targets become entirely irrelevant. They become something that doesn't warrant consideration. If you remember back to 2008, 2008 was a paradigm shift that truly changed absolutely everything. 2008 wasn't just a simple run-of-the-mill liquidity, insolvency crisis, even though that's what we've been told. 2008 was, quite frankly, to central bankers, a revelation. An apocalyptic revelation, an epiphany of sorts, if it were a dour manifestation of an epiphany, but it showed policymakers something very, very terrifying, something that they probably weren't aware of before. The system was not robust. The system was not anti-fragile. The system was not resilient. The system was incredibly fragile. That was the revelation that faced central banks back then. And worse, it was fragile in places that no one could actually easily observe and no one could easily see. A bit like Schrodinger's cat, right? Only does it exist once it's observed, or do you change its existence entirely? Mortgage securities weren't actually the problem. They were the trigger. They weren't a symptom. They were the firing pistol, the firing gun that enabled the critical mass to go nuclear. The real problem was leverage layered on top of obfuscated leverage inside institutions that were assumed to be AAA when they were built on a Jenga board full of triple B dog you know what. After 2008, central banks around the world, they learned an entirely new lesson. You do not let balance sheet unwind in real time. You can't do that. That is the end game. That is the no past 200, no past go collect $200, right? We cannot let balance sheets unwind in real time. You can do something else though. You can freeze them, let them stand still where they are. You can support them with an abundance of stimulus and liquidity. You can absorb them if necessary. You can reclassify debt that is entirely toxic to non-toxic in a custodian holding bank. Because once liquidation starts, it doesn't just stop politely. The quiet mandate shift is where the real problems arise and where we can see how central banks have completely changed diametrically in terms of what they do and their function, importance and significance in the economy and society at large. No press conference announces these things, but the mandate has quietly shifted. If you've been watching closely, you've probably noticed how the mandate has shifted. It's shifted from controlling inflation over the cycle to something completely different. That was the mandate before, to control inflation over the cycle period. It's now shifted to prevent disorderly balance sheet collapse. And that's where we exist right now in terms of how we need to be interacting with the forward pricing mechanism and the reaction functions when we look at central banks. Because inflation has become simply a variable and stability has become the objective. When you mix in the interwovenness of the Treasury and the central bank, that's how we can see fiscal dominance rearing its head. So this is why policy feels incoherent to retail observers like me and like I imagine you are. Because they are still watching the old scoreboard, the scoreboard of yesteryear, of the good old halcyonic days when things were simple and when people didn't look too deeply into the miasma. Inflation is now a secondary and even tertiary condition, even though they would have you believe it's the most important variable that goes into the input models. Why is inflation now secondary? Well, let me be precise about this, completely technical, above board and transparent. Inflation still obviously matters. It just matters until it conflicts with balance sheet stability. At that point, it no longer matters. At that point, inflation loses. And that's why you see the equivocation and the oscillation between the mandates and the apparent mandates of the central banks. Inflation will always be superseded and surpassed in terms of importance when it comes to balance sheet stability, because that is literally the firing gun, and within it lay the bullets and the arsenal weaponry with which they fight the next crisis. So at what point does inflation lose? Well, it loses at every point and at every time. Why? Why does it lose? Because inflation is a slow tax. Balance sheet collapse is an instant death. So of course, it has to be prioritized. Governments and populations, they can survive inflation. Yeah, the times will get hard, the belts will need to be indubitably tightened, but they cannot survive systemic insolvency. That is the end games. That's the end scenario. That is not ideology. That's not my own idiosyncratic thought path. That is political reality, realpolitik and political physics, if there was such a thing. I suppose it's called political science in some way. So how did we get into the balance sheet trap? Well, you'd have to watch another video of mine to find out. I'll be conducting another video or filming another video on how policymakers get trapped in the balance sheet trap. And there are some clues as to where it goes, but tune in next time and hopefully we'll go through it. A clue is high debt levels, high indebtedness and huge debt to GDP ratios. But my name's Justin Benton. Thanks for joining me. Ciao for now.